Okay, my name is Nancy Roberts. I'm a professor of economics at Arizona State University, and today I want to discuss a market failure. Economists love markets, and we think markets are incredibly efficient, but there are some situations where markets do not work. And as economists, we call these market failures, and we have ways to deal with these problems. We have different ways to deal with the problems of externalities. And so the first thing I want to do is just sort of define externalities. And an externality is what we call a third-party effect, or a spillover effect, or third-party benefits or costs. And so what we mean by third-party is if there's an exchange between a buyer and a seller, that's two parties, a buyer and a seller. If somehow a third party who's not involved in this exchange either has costs imposed upon them because of this transaction or actually receives benefits because of this transaction, then that's what we call an externality. Externalities can be positive, they can be negative. But the thing about externalities is if they're positive or negative, it doesn't matter because the market fails in either case. And so what we want to do is look at an externality. The first thing I'll explain is a negative externality. An example of a negative externality could be some kind of pollution. Or it could be, let's say, you go buy a package of cigarettes. That's a transaction between you and Philip Morris, perfectly legal transaction. And then you come into my office and light up and blow smoke in my face. Okay, I don't like smoke, you're imposing costs on me. And so that's what we call a negative externality. Now, some externalities are real easy to solve. We don't need government interaction at all. I just say, put out the cigarette or leave. So that's a simple way to handle the problem. But when we get to pollution in general, noise pollution, air pollution, these problems are not a problem where I can just say to the person who's in my office, get out. So what we have to do is look for ways to solve these problems. And so the first thing I'm going to do is illustrate a negative externality. So let's just say this is the market for bug spray. Bug spray, to kill bugs. Of course, there's a demand for bug spray, and of course, there's a supply of bug spray. And in fact, this would be the equilibrium price, P star, and this would be the equilibrium quantity. So every time period, Q star cans of bug spray would be exchanged between the producer of the bug spray and the buyer at a price of P star. Fine. Okay, it's fine unless we assume that in the production of this bug spray, there's some nasty byproduct created. I mean, here's the factory. There's the door. There's the doorknob. They have windows. And they have a chimney. And every day they make these cans of bug spray. But what happens is some nasty byproduct is created in the production of the cans of bug spray. And every night when they've finished making bug spray for the day, they have to get rid of that byproduct. What are we going to do? We can't leave all this crud, this pollution here in the factory. Well, hey, we could do that, couldn't we? Or, oh wow, look at this. We could locate near a stream. And we could just dump the effluent into the stream. And that way we're rid of all the crud, and then the next morning everybody comes back to work and the building's all clean, there's no crud. So the problem is there are two kinds of costs here. There are, for the producer, there are the internal costs. What it actually costs for me to gather these chemicals, put them all together, put them in a can, and run my business. The other costs are these external costs, these damage costs. Costs that are being imposed on society that the bug spray company isn't internalizing. And so this isn't the true cost curve. This is, supply curves, you'll remember from earlier on, is basically a summation of all the marginal cost curves. So this is, we call this marginal cost private. meaning these are just the marginal costs of producing bug spray to the firm itself, the private internal costs. But we know there's more costs involved. And in fact, if we included these damage costs, then our supply curve would be higher. And so instead of E1 being the equilibrium, the true equilibrium, I'm going to call this supply equals marginal social costs. Marginal social costs include the private production costs and those external costs, the damage costs. Now, these are not easy to estimate. All the fishing, all the recreation's been lost. People with black lung disease. Those are positive costs. They're not easy to estimate, but we know they're a positive cost. And so, what we do, we have different ways to solve this problem. What we know is that if this supply curve actually includes the value of these external costs, that then this would be the true supply curve, which means this would be the true equilibrium. This leads us to, there's a whole lot of interesting questions around this, and that is, what is the optimal amount of pollution? And of course you say, well, 0 is the optimal amount of pollution. How are you going to get 0 pollution? Well, we could get rid of cars. That'd be a good start, right? No cars. We could get rid of all coal-fired plants, natural gas, all of that. And then we'd have no electricity. Well, the problem is the optimal amount isn't 0. The optimal amount is where the costs of having this pollution are offset by the benefits of the bug spray or the cars or whatever. So it's a tough question. I mean, we could ask ourselves, what's the optimal number of deaths on the highway? Car crashes. What's the optimal number? Well, 0. How do you get there? 5 mile an hour speed limit? But you know, if you drive 5 miles an hour, you hit an old lady driving a Hummer, you're driving a Hummer and you hit an old lady, she's going to die 5 miles an hour. You can't reduce it to 0. So what we look for is the optimal amount. And if this distance right here represents the per unit external cost associated with every can of bug spray, that means we have to be able to put estimates on this damage. Then this is the true supply curve, and Q2 is the optimal amount of bug spray, and the price of P2 is the new price. Now, what people will say is, how are you going to make this firm internalize this damage? Okay, so that is the true cost. How do you make him, this firm, the bug spray firm, internalize the cost? You can't just ask him to do it. You can't say, oh, come on, be nice. Look at the kids. This is terrible. That doesn't work, because if only he does it, then it puts him at a competitive disadvantage with all the other bug spray companies. So you have to enforce it. And so what you say to him is, okay, make bug spray. We don't care. We know it pollutes. But every time you make a can of bug spray, you give me, Uncle Sam, the government, this tax. So you've just raised his costs by that amount. And again, the tax is meant to be an indication of the cost of the damage. And then the government collects. So let's see what the government collects here. So now we only sell Q2 cans at a price of P2. And you can see that here, right here, this distance is that amount of the tax. So the government's going to tax them. And I'll call this P0. The supplier receives P2 for every can of bug spray, but he doesn't get to keep P2. He has to turn around and give the government this tax on every can. So the government collects revenue equal to, I'm going to call this point A. The government revenue is this area here. The government collects on Q2 cans this distance right here. So all of this is government revenue. And then we can assume that this money will go to the EPA, who then will take that money and clean up the river. Another comment you always hear about externalities is, well, if you tax this producer of bug spray, they're just going to pass the costs right on to the consumer. They're the ones who are polluting, and they're just going to pass it on to the consumer. And I would ask you to think about that, because who benefits from bug spray? Well, the producer benefits from bug spray because we assume that this price leaves him with some profits. But also the consumer benefits from bug spray, or you wouldn't be buying it. So both consumer and producer benefit from the production of bug spray and this external damage. So who should pay for the cleanup? Well, the people who benefit. So both the consumer and the producer should pay for this. People say, well, it's the producer who's doing it. The only reason he's doing it is because the consumers want this. And so when we look at this, what we can see is that this tax revenue that goes to the government to clean up, some of it is paid by the consumer and some of it is paid by the producer. The original price was P star. That's what the consumers used to pay. Now the consumers pay a price of P2, but you can notice that the difference between P2 and P star isn't $1 or whatever this tax was, if that tax was $1 a can. It's only a portion of that. And so the original price for the consumer went up This is the consumer's share of that tax revenue that's collected. And this is the producer's share. So the consumer and the producer both share in the cost of this tax on pollution. And following this video, we'll show you an example using actual equations for supply and demand curves and imposing a tax on the firm. After this, there's a couple more ways I want to discuss. Besides the tax on pollution, there's another way we can solve this problem, and that is by setting standards. We'll talk about that in the next video. And a third way is to create a market for the right to pollute. And so in the next two videos, we will explain those other methods. This method is the tax method. And this only refers to a negative externality. We haven't talked about positive externality. I'll briefly do that by just showing you how it works. A positive externality would be like a measles vaccine. If I go get a measles vaccine, that's an exchange between me and the doctor. I give him some money, he gives me the vaccine. I'm never going to catch the measles, and I paid for that. But you're never going to catch the measles from me. And what did you pay for that? Nothing. So you're receiving a benefit for which you've paid nothing. And so that graph looks like this. Here's the supply of vaccines. I don't know if you spell that right. Vaccines, maybe 1C, maybe 2. There's the price, here's the quantity. There's a demand for vaccines. This demand is the private demand. This is how much individuals value having a measles vaccine. And here's the price, and here's the output, Q1, P1. The trouble is this demand curve only represents private demand. It doesn't represent the benefits that go to everybody I come in contact with. And so the true demand curve, we always call it a marginal benefit curve. This is a marginal benefits private. These are just benefits going to individuals, but others benefit as well. So the true benefit curve, I'm going to call this marginal social benefits, is out there. So instead of E1 being the true equilibrium, the true equilibrium is out here, which means the socially optimal number of vaccines is Q2. But if you look at the individual's private demand curve, for Q2 vaccines, people are only willing to pay P2, but it actually costs P3. So how do we get people to buy more vaccines than at a price higher than what they value it? So this vaccine right here is valued at this price, but it actually costs this. So what the government does is they subsidize vaccines. And in fact, the consumer, I mean, there are different ways we do this. You know, the consumer will pay this bit, and then the government will subsidize the vaccine maker or the doctor by the difference. Without this subsidy, we're going to get this E1 as our equilibrium. And what we have with E1 is this dead weight loss. Dead weight loss. Because here's the true demand, here's the true supply, and if we only have Q1 of these, all of these benefits in excess of costs are not going to be included in the market. This would be called a dead weight loss. We have a dead weight loss over here too, which I didn't indicate. This in my negative externality example. If we leave this alone to the market's going to give us Q star, which means here's the true cost, here's the benefit, and so every unit between Q2 and Q star has costs greater than benefits. So there's my dead weight loss. Anytime you produce where costs are greater than benefits, or if you stop short of producing where costs equal benefits, you've got a dead weight loss. So we have that in either of these cases. They're both externalities, and the government can solve these problems by either taxing a negative externality or subsidizing a positive externality. The problem is always in trying to determine the amount of the damage or the amount of the external benefit. And we'll do a problem using this following this video.